My name's Paul Bevan, mortgage broker and investment property specialist. Today I'd like to talk to you around debt consolidation or about debt consolidation. Some of the benefits, some of the things to look out for, and some other options if you are struggling with repaying your debts. Now, look, unless you were brought up as a young child, with parents that gave you a really solid understanding of good debt and bad debt and the uses of credit, you most likely at some stage in your life have had a credit card or a personal loan or something to that effect. Now, sometimes they can get out of hand in relation to the amount of income that's coming in and maintaining those repayments. And sometimes debt consolidation can help you get back on top of that situation. So what debt consolidation is basically is where we're rolling our high interest debts, so things like credit cards and personal loans or store cards, into a lower interest product. Now, typically that would be a home loan product or a mortgage product for those of you that are homeowners. And that's the typical situation where we would see a client doing a refinance and consolidating those debts. So accessing some of the equity available in your property. Obviously, a home loan interest rate of around 4 or 5% is going to be much lower typically than you're paying on a credit card, which could be anywhere sort of between 13 and even up to 20%, or a personal loan as well, which again could be anywhere in the region of 9 up to possibly 17 or 18% as well. So what we're trying to do there obviously is to reduce the amount of interest and fees that we're paying. That's obviously going to improve our cash flow and obviously hopefully eliminate a little bit of the stress associated with having to service those high interest debts. Some of the things to consider though, if you don't currently have a home loan or a property that you can borrow against, there are also some other debt consolidation loans, which are typically unsecured personal loans. However, they're probably in the region of that, at least 13 or 14%. So if you're comparing that to, another personal loan that you have, which might be secured, perhaps, a car loan or something like that, or a lower interest credit card, it might not be worthwhile. So in other words, there might not be enough savings in terms of the fees and interest that you're paying to actually consolidate those debts. So that's certainly something that you need to keep in mind and to consider. Another option that people also often use is a lot of the credit card providers will offer a 0% balance transfer, potentially for 6 months, for example. That can sometimes help your situation as well, but there's also a couple of things to be wary of there too. The first one is if you're going to continually switch across those products, there's going to be a number of inquiries on your credit file for each time you apply for credit and apply for that 0% balance transfer. That is most likely going to have a negative impact on your credit rating. So the number of inquiries on your credit file can have a negative effect on your credit rating and your credit score. So when you do go to apply for credit further down the track, for example, for a home loan, that can actually count against you. The other thing that you need to certainly keep in mind is that if your behaviour doesn't change, so in terms of your spending patterns, and you then continue to rack up more credit card debt, perhaps you might take out another credit card down the track, you're going to end up in a worse situation and in more debt than you were in before. So it's really important to make sure that doesn't happen as well. Some of the other things to consider, there could be high exit fees on some of those products. So For example, you might have a fixed rate personal loan or something like that, where the exit fees are quite high. So again, that can affect the benefits in terms of looking to consolidate that debt into another product. There also might not be, as I mentioned before, a big enough savings in terms of the interest repayments. So, there's probably not much point switching from a 14% credit card to a 13% personal loan or something like that. It's probably not going to provide the savings that you're after. As I mentioned, the biggest risk when consolidating your debt is not changing your behaviour and not changing your spending patterns as well. A couple of other options. Obviously, if you are struggling to repay your debts, there's probably two methods. One's really to do with the mindset of scarcity, and that's would involve obviously reducing your expenses on a monthly basis. That can obviously, help. However, my preferred method, and I think it's probably for those of you with a mindset of abundance, is to increase your income. Now, that could either be through taking a part-time or a second job, for a short period of time until you get on top of those debts, or even starting a small business, which I think is a fantastic way to increase your income. So there's just a couple of other things to consider. So there you go. That's pretty much all I wanted to mention in terms of debt consolidation. If it is something you're interested in doing, and you would like to look at, refinancing potentially your existing home loan and consolidating some of those debts and accessing some equity in your property, please feel free to give me a call on 0433 994 693.